Welcome to the Leaders Insights podcast. Today's episode, recalibrating hurdle rates when the risk-free rate is no longer free. Most companies are still using a hurdle rate they set in 2015. Tell me why that's not just lazy, but actually destroying value.
Because a hurdle rate, the minimum return a project has to clear before you fund it, is supposed to reflect what capital costs you today, not what it cost during a decade of free money. And here's the dirty secret. Half the CFOs I talked to never touched theirs. They ran near zero rates for years, mentally anchored to a 8 or 9% hurdle. And then the risk-free rate, or the return on government bonds, the floor under everything, climbed to 4+% and stayed there. Their hurdle didn't move an inch.
So they're undercharging their own projects. Isn't the fix obvious? Just add the extra points back?
That's the consensus, and it's wrong in a subtle way. Everyone races to bump the number up. But the mistake isn't the level. It's that they treat one hurdle rate as gospel across the entire company. A software division and a heavy manufacturing division do not have the same cost of capital. When you use a single blended rate, you systematically overfund the risky stuff and starve the safe, boring cash generators.
Give me a real example. Who actually got burned by this?
Look at the industrials that overinvested in speculative hydrogen and battery ventures around 2021 and 2022. Siemens Energy is the cleanest case. They were greenlighting long-dated projects against a cost of capital that assumed money stayed cheap forever. When rates normalized, the math on those projects fell apart, and by 2023, they needed state-backed guarantees. That's not a market accident. That's a hurdle rate that lied to them.
You're saying the model told them yes when the answer was no.
Exactly. And this is where I get cocky, because the weighted average cost of capital, the WACC, your blended cost of debt and equity weighted by how much of each you use, is not some mystical constant. It has 3 moving parts, and most people freeze 2 of them. The risk-free rate moved, the equity risk premium, the extra return investors demand for owning stocks instead of bonds. That's arguably higher, too. And your debt just got more expensive if you refinanced.
Walk me through the numbers so a listener can actually rebuild this.
Say your risk-free rate went from 0.5% to 4.2%. That's 3.7 points that should flow straight into your cost of equity, the return your shareholders expect. If equity is 70% of your capital structure, that alone lifts your WACC by roughly 2.5 points. So a hurdle that was 8% should honestly be closer to 10.5 or 11. Any project sitting between those 2 numbers looked profitable and quietly wasn't.
But won't a higher hurdle just kill investment? Isn't that how companies stagnate?
That's the fear, and it's backwards. A too low hurdle is how you stagnate. You spread capital across mediocre projects that all clear a fake bar. Raise the bar honestly, and you fund fewer things. But the survivors are real. Discipline isn't the enemy of growth. Sloppy discounting is.
What about the CFO who says, my board wants stability, I can't be changing the hurdle every quarter?
Then don't. Set it annually based on a trailing average of the risk-free rate and publish the logic. What you can't do is keep 2015's number and pretend it's a law of physics. The other trap, companies now overcorrect and slap a 15% hurdle on everything to look conservative. That's just laziness wearing a more expensive suit.
So the sin flips from too generous to too paranoid.
Right. Both are the same intellectual crime, refusing to actually do the arithmetic per business unit. A regulated utility arm and a venture stage bet deserve different rates because they carry different risk. One number for both is management by vibes.
Give me the one thing a CFO should do Monday morning.
Pull your current hurdle rate, subtract today's risk-free rate, and look at the gap. If that gap is smaller than it was in 2020, your model still thinks money is free. You and every approval you've signed this year deserves a second read.
That's a wrap. Fresh CFO briefings drop daily at mba-training.com.